Oliver, the Qatari Investment Authority and Brookfield want to take control of the company that controls Canary Wharf, and they're willing to pay 350p a share to do it. Does that look like a good price?
Well, that depends on what kind of perspective you want to take. If you look at the share price, that compared to where the shares were at the start of the year, 165p, that looks like a fantastic price in a year to get that kind of increase. But
You're talking about the share of Songbird.
The shares of Songbird Estates, yes. Songbird owns 69% of Canary Wharf Group, which is the group that owns the bricks and mortar out in London's Docklands. And Songbird is what this bid approaches over. Now, as I say, 350p against 165p at the start of the year, that looks great. However, Songbird recently had a valuation carried out which said that its net asset value, that's the value of the assets underlying the shares, was 381p a share. So against that 381, the 350 doesn't look so great.
So could investors in Songbird do better by simply holding on?
Well, potentially. Songbird has a lot of developments underway. It's spent the last few years planning the next stages of this great sort of growth out in Docklands, and it's got a lot of developments coming in the next few years. And it says that those developments are not accounted for in the net asset value, suggesting that net asset value might actually be a low point, and it might go well north of there.
We've heard this story before from other companies that have received bids from the...
Yes, right. Very much so, very much so. And, you know, who knows what's going to happen in the future. Yes, there's a lot of demand for London property at the moment, but maybe London goes off the boil, maybe all the investment banks that occupy all that space in Canary Wharf, maybe they decide to pull back their trading activities and they don't need so much space anymore. So it's questionable how long it will take to develop these new properties that they're proposing and what demand will be like when it's finished. So there's a lot of uncertainty out into the future.
The bid is below net asset value. There's more development to come in Canary Wharf. Surely the answer is to hold on.
Well, except that there is a cash offer on the table, and a cash offer at a huge premium to where the shares were a year ago. And perhaps it all boils down to a long-term view on where you see the future on the London property market. It's obviously very hot at the moment. There's a lot of money coming in. But you know, it's an awful lot easier to sell on the way up than on the way down. And it's very difficult to time the very top of that market. And I often think if you're sitting on a large profit, which Songbird shareholders will be at the moment, particularly if they sell out at 350p, then that's a profit in the bank to be reinvested elsewhere. Yes, you could hold on. It might go well north of that, but it might never reach that. And in any case, with the net asset value, Songbird's shares rarely trade in line with or above its net asset value. Usually they trade at a discount. So it's very questionable whether you will actually ever achieve whatever the stated net asset value is. So it might be a good time to cash in.
Thanks, Oliver.